Hello, I am Jamie McDonald, your host for Before and After, powered by Refinitiv. The word bellwether is defined as the leading sheep of a flock. It is formed by a combination of the Middle English words bell, as in bell, ding ding, and wether, a word that refers to a castrated male sheep. Over time, it has come to mean an indicator or predictor of events or actions. It is a word that comes to mind when talking about our first Before segment, the upcoming FedEx earnings announcement. Our second Before segment looks at the addition of Aramco to the MSCI index. Our After segment begins with a nice serving of crow as we talk trade deal. Let's get to it. Since its founding in 1971, FedEx has become ubiquitous with shipping, and as far back as 1980, the stock has been a leading market indicator, tightly tethered to the broader S&P. That has changed. As the S&P has continued to climb through all-time highs, FedEx has decreased 31% in 2019 alone. When FedEx made their tactical decision to end their domestic express and ground delivery agreement for Amazon, they were already in the weeds and facing devastating margin compression on the deal. It represents a loss of $900 million in revenue and has largely been priced in on FedEx. Amazon didn't miss a beat when this happened and simply developed their own ground fleet distribution system. Compounding the trouble is the fact that FedEx is stuck directly in the middle of the US-China trade war. Beijing considers FedEx a potentially unreliable foreign company and has been investigating them for illegal shipments of knives in Hong Kong. Throw in some diverted Huawei shipments, a lawsuit with the Commerce Department, and a spat with the New York Times, and it gives us a lot of reasons not to be confident in this upcoming earnings report, which is why it may be ripe for long-term investment. Realizing there is a difference between trading and investing can allow us to sometimes act based purely on price action and timing to great result. FedEx's narrative and earnings momentum is, to put it bluntly, horrific. And yet the stock finds a baseline support level near $150 a share. From the long side, the risk reward has an investor risking 5% for a 15% return, should it return to May levels of $190. A look at how FedEx has lagged main competitor UPS in 2019 makes a long-short spread very compelling. The spread covers all bases should the global macro conditions and broader markets deteriorate, as it's safe to assume UPS will not be immune. Much has been made about the recent listing of Saudi Arabia's Aramco, the world's largest company by market value. While the focus has been directed primarily on Aramco's nearly $2 trillion valuation, albeit on a 1.5% float, we are going to look at how Aramco affects other stocks and countries with its upcoming addition to the MSCI index. Last week, Aramco listed shares in Saudi Arabia, and the stock jumped 10% in the first day of trading, achieving the eye-popping valuation. We need to question if this is real price discovery for a couple of reasons. First, only $240 million worth of shares traded, and yet the company added nearly $200 billion in market cap. Second, the buying was mainly domestic retail, with 2/3 of the IPO being held by Saudi locals who are encouraged to hold their shares for 6 months to receive a bonus. This makes for sexy headlines and marginal impact for Western investors. We don't expect Aramco to be a big factor in your ETF holdings anytime soon, given that most ETFs operate on a float-adjusted basis. The adjustment in Aramco's case is $29 billion. Even in the MSCI Emerging Market Index, which had a total market cap at nearly $6.5 trillion, Aramco makes a small impact, coming in at 0.05% of the index, putting it in 25th place. We should be looking for some index arb players selling the larger emerging market countries in anticipation of Saudi Arabia getting a bigger slice of the pie, and any excess selling in China or Korea would be an opportunity for a long trade. Also, within ETFs like EEM, Aramco could lead to selling in other emerging oil names such as Petrobras and Gazprom, which could set up nicely for a quick long swing trade. When you do a segment like the one we did on the tariffs cliff, a deadline that can be resolved at any moment, you speculate and you run a risk. I believe my exact words were, and least likely at this stage, something no one is expecting. A comprehensive deal is announced. Euphoric risk-on would ensue. But please don't hold your breath. Seriously. And so right on cue, in the short window between filming this segment and airing it, phase 1 of the trade deal was completed. So, some days you eat the bear and, well, you know the rest. The deal for phase 1 was more decisive language than we would have anticipated. In addition to deferring any further tariffs, it lightened the burden of some existing ones. Early reports claim we could see cuts of as much as half of the current tariffs on Chinese goods. It is also predicated on the Chinese purchasing an extra $50 billion of agriculture from the US. And of course, they promised to crack down on intellectual property theft. And the markets once again did not care. A garden variety bump of 30 basis points in the S&P. The precarious nature of the promises is probably why the markets simply shrugged. This has been Before and After, the twice-weekly market show powered by Refinitiv. I am your host, Jamie McDonald. Dion will be with you next episode, and I will see you after the holidays. Be sure to like, subscribe, and share us with your friends. Click the bell if you want to be notified of new episodes. Happy holidays.